Homebuilder sentiment in the single-family home market fell 8 points to 38 in October from the previous month. That drop comes after falling 3 points in September. This according to the National Association of Homebuilders, Wells Fargo Housing Market Index. Now, over 25% of new home prices are discounted. Rising interest rates have caused homebuilder confidence to tank. The average interest rate on the 30-year fixed mortgage was more than 7% this week. That rate was 3% at the beginning of this year. Persistent inflation is causing higher costs for labor and materials. Higher costs for land are driving up development costs. So, new home builders are caught in a market squeeze. Sensing that home prices are in free fall, home buyers are now pulling back from the market. Intensified housing market correction has homebuilders offering sweetheart deals to Wall Street. But, is this just a market correction? Or, is this a housing crash? What does this mean for new home development? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Homebuilders have a housing downturn playbook that's proven to be effective time and again. They start by offering incentives like mortgage rate buy-downs. If that doesn't work, then builders begin to mark down home prices communities until their unsold inventory has been moved. Fast forward to 2022. Homebuilders have clearly returned to housing downturn operating mode. But there is a new player in the game: institutional investors. After the 2000s housing bust, institutional investors jumped into the market. Firms like Blackstone saw an opportunity to buy directly from distressed builders. They created the so-called build-to-rent category. It means that builders are already pitching big-time markdowns to Wall Street buyers. Lennar is already shopping 5,000 unsold houses. That is more than the entire total active inventory in Kansas City. Investors can now buy entire subdivisions at a discount in some cities in the U.S. South. What's an interesting dynamic with the institutional investors, said Ali Wolf, chief economist at Zonda. A lot of them have been sitting on the sidelines waiting for that moment to strike, continued Wolf. They are thinking, hey, I want to buy these homes from you, the builder, Wolf continued. But I want to have a discount to do so, Wolf said. Homebuilders' housing downturn playbook has proven to be effective again and again. Step 1. Offering incentives like mortgage rate buy-downs. If that doesn't work, then Step 2. Begin to cut prices until their unsold inventory has been sold. If that doesn't work, then Step 3. Unload the houses wholesale to institutional investors at a hefty discount. These institutional investors don't just want markdowns in the 10% ballpark. They are demanding 20% and 30% price cuts, says Wolf. With the current average 30-year fixed mortgage rate at 6.28%, people are still buying some homes. So, the housing market downturn is still very much alive. And with mortgage rates down from recent highs, the bottom for housing demand might be in the rearview mirror. So, some institutional investors might be ready to pull the trigger, Wolf said. What we're hearing now is that some investors, because mortgage rates have come down, they're afraid that primary buyers are going to come back into the market, Wolf continued. Some institutional buyers are rushing in to buy houses in bulk. But there are 3 big reasons why homebuilding giants are selling to investors now. First, the ongoing housing correction has intensified recently. Second, home buyer cancellations have spiked to 26%. Third, they are anticipating a weak housing market in the spring. Add it all up and builders are discounting faster and making sweeter deals to investors who can buy in bulk. Remember, homebuilders still have a huge number of homes in their inventory. That includes single-family and multifamily, somewhere in the building pipeline. Builders are eager to get this backlog sold before construction is even finished. I expect the historic pipeline of unfinished homes to continue to depress new home prices, said Wolf. That will continue at least through the first half of 2023, Wolf continued. But once standing inventory has been cleared and the pipeline is under control, the pressure on new home prices should ease up, Wolf also noted. Just how many of these homes will go to institutional investors? It's hard to say. Investment companies such as Blackstone have said they intend to continue to grow their real estate portfolios. Some institutional buyers have also temporarily moved to the sidelines. They see the ongoing housing correction as a falling knife that is hard to catch. Take Blackstone-owned Home Partners of America, for example. They are one of the country's largest private landlords. Home Partners of America stopped buying single-family homes in 38 U.S. regional housing markets. Blackstone and Starwood both moved to limit withdrawals from their real estate funds. That is because redemption requests from investors are also spiking. Which means that the shareholders in these institutional funds do not see housing as such a great investment right now. And this will affect their plans for future real estate investments. The housing downturn has homebuilders scrambling to move their existing inventory. But it does not mean doomsday for builders. Just look at the share prices of the largest homebuilders. While major homebuilders are all down from their 2022 highs, they're still well above their January 2020 share price. D.R. Horton is up 72.9% since January 1, 2020. Lennar Plus is up 67.4%. Toll Brothers is up plus 30.2%. NVR is up 28.5%. And Pulte Group is up 21.8%. During the same period, the S&P 500 index rose 22.5%. Homebuilder sentiment for the U.S. single-family home market has now fallen dramatically. Right now it is only half of what it was just 6 months ago. As you know if you follow the news and watch this channel, inflation is raging in most countries of the world. Central banks in most countries are aggressively raising interest rates to fight inflation. As a result, lending rates of all types are increasing. That includes mortgages. The mortgage rate on the benchmark 30-year fixed-rate mortgage in the U.S. has more than doubled since the start of the year. So home prices are becoming more unaffordable to many Americans. The National Association of Home Builders, NAHB, Wells Fargo Housing Market Index, HMI, is designed to gauge market conditions. This index fell 8 points to 38 in October from a level of 46 in September. The index now stands at its lowest level since 2012. The index is considered to be negative whenever it is below 50. Homer builders continue to blame aggressively rising interest rates for the decrease in confidence. The index has 3 components. The current sales conditions component declined 9 points to 45. The sales expectations in the next 6 months component fell 11 points to 35. The buyer traffic component fell 6 points to 25. And buyer traffic is a big indicator because it means that buyers are just not showing up. For the past 5 years, home buyers were typically having to pay over listing price and compete in a bidding war. But now, the average home in the United States is selling for less than its list price. Despite all of the publicity about a housing market crash, home prices are still higher than a year ago. Zillow has sold its portfolio of properties at a substantial discount. Zillow stock is down almost 70% from its 52-week high. The CEO of Redfin has warned that his company is quickly selling off properties in its portfolio. Redfin stock is down over 75% in 2022. Housing markets in several U.S. cities are still seriously overvalued. Boise, Idaho is 72% overvalued. Austin, Texas is 67% overvalued. Ogden, Utah is 64% overvalued. Las Vegas, Nevada is 61% overvalued. Atlanta, Georgia is 58% overvalued. Phoenix, Arizona is 57% overvalued. Provo, Utah is 57% overvalued. Housing prices are falling in many U.S. cities. But how far will they go? Experts predict that house prices could fall by up to 25% over the next few months. Homebuilders are having to offer aggressive discounts. And they are canceling new building projects. Housing developers are seeing the pace of new home site visitors is slowing down. Customers are canceling contracts. This could lead to the perfect storm that culminates in a foreclosure crisis. A housing crash could have devastating ramifications for tens of thousands of Americans. On the positive side, this could be an opportunity for first-time home buyers. Tech layoffs are a primary reason why home prices in technology hubs fell 0.77% from June to July of this year. This is especially true of tech companies in e-commerce, real estate and those closely related to the stock market. Tech companies doubled layoffs and hiring freezes in 2022 as compared to 2021. Tesla laid off 229 autopilot workers. Netflix cut 300 employees. Coinbase cut 18% of its workers. Robinhood cut 23% of its employees. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.